Imagine walking through the same doorway every single day. The doorframe is a very specific, fixed height.
Right.
But year by year, the floor you are walking on imperceptibly rises. You don't really notice at first, because the change is so gradual.
Yeah, just a fraction of an inch at a time.
Exactly. But eventually, inevitably, the floor gets so high that you smash your head right into the frame.
Ouch.
Yeah. Welcome to today's deep dive. Today is Wednesday, May 6, 2026, and we are looking at a creeping financial trap that guarantees millions of future retirees are going to hit their heads.
It's a phenomenal way to visualize a mechanism that usually gets buried in, extremely dry economic reports.
Right, the stuff no one wants to read.
Exactly. I mean, when you're in the middle of your career, retirement planning often feels really abstract.
Yeah.
You kind of just assume the rules of the game are locked in, you save up, you stop working, and you draw your pension.
Sounds simple enough.
Right. But the source material we are examining today suggests the rules are, well, they're quietly being rewritten right underneath our feet.
And our source for this is a really sharply written policy argument titled The Case for a Tax-Free State Pension.
It's a fascinating read.
It really is. And the mission for our deep dive today is to unpack the mechanics of something economists call fiscal drag, explore exactly how it ambushes retirees in real time, and examine the author's surprisingly narrow, highly specific proposed solution.
Because, as the text makes abundantly clear, this isn't just an issue for people currently in their 70s or 80s.
No, not at all. If you are working today, you are a future pensioner, which means this trap is, it's being set for you right now.
Just a quick heads up before we get into the actual math of all this.
Yeah.
The author of this paper has some very direct, very pointed political perspectives regarding taxation and UK government policy.
Oh, absolutely. They don't hold back.
They do not.
Yeah.
So just to be clear, we aren't here to pick sides, endorse those views, or bash any particular administration. We're simply going to run the math, test the argument, and, see if the logic actually holds up to scrutiny.
Okay, let's unpack this. To understand the author's palpable frustration with the system, we really have to look at the raw numbers.
The math is where it all starts.
Right. So in the UK, everyone has a personal allowance. That is the baseline amount of money you are legally allowed to receive each year before you owe a single penny in income tax.
And according to our source, that allowance has been frozen at £12,570.
Right, £12,570.
Yeah, and it has been stuck at that exact figure for years now.
And for most people, any income below that line is completely tax-free.
Exactly. But the moment your income ticks over that £12,570 mark, the basic rate of income tax kicks in.
Which is 20% for England, Wales, and Northern Ireland.
Yeah.
Now we had to look at the floor rising underneath our doorway. The basic state pension in the UK is paid out at £1,053.04 every 28 days.
And because there are 13 of those 4-week payment cycles in a year,
it end up with an annual state pension of £13,689.52.
So your tax-free doorway is frozen at $12,570, but the pension you automatically receive from the state is $13,689.
What's fascinating here is the precise mechanics of that collision.
Let's hear it.
If we take the annual state pension of roughly $13,689 and we subtract that frozen £12,570 allowance, we're left with a difference of £1,119.52.
Okay, so that is the specific portion of the state pension that has crossed the threshold.
Yes, that's the part of your head smashing into the doorframe.
Oh, wow. Yeah. And because that $11,919 difference is now subject to the 20% basic rate of tax, it generates a tax bill.
How much are we talking?
Exactly £223.90 per year.
Wow. Over 200 quid.
Yeah. And the author emphasizes that pensioners are not being dragged into paying this tax because they have suddenly become wealthy.
Right. They haven't gone back to work.
They haven't won the lottery. They are being pulled into the tax net entirely because of fiscal drag.
Let's actually define that for a second, because fiscal drag sounds like something, an accountant mumbles before handing you a massive bill.
It does sound a bit clinical.
Right. From what I understand in the text, it's a deliberate policy choice, right?
That's the argument.
Like inflation pushes the state pension up because the pension has to rise so people can afford more expensive groceries and heating and whatever.
Sure.
But the government intentionally freezes the tax threshold. So without ever announcing a tax hike, the government quietly turns millions of people into taxpayers.
That is the absolute essence of fiscal drag. It is often referred to in the source as a stealth tax
Stealth tax.
because chancellors love it. They can raise billions of pounds without ever having to stand at a podium and announce, hey, I am raising the basic rate of income tax.
Right, they just do nothing.
Exactly. The threshold just stays completely still while inflation does the dirty work of pushing people over the line.
Which brings up a logistical issue that, frankly, really confused me when I was reading the source.
Oh, yeah. What was that?
Well, if the government knows this math they know the allowance is frozen, and they know they are paying out a pension that exceeds it, why don't they just deduct the $223,000 before they pay the pensioner?
That's the logical question.
I mean, throughout your entire working life, under the pay-away system, or pay-as-you-earn, your employer deducts your tax before the money ever hits your bank account.
Right. It's seamless.
So why does the government hand out the full pension and then ask for some of it back?
The author actually spends a lot of time on this exact structural absurdity. And the reason comes down to the architecture of the government itself.
Okay.
The state pension is distributed by the Department for Work and Pensions, the DWP.
Right.
Their mandate is simply to pay the pension gross, meaning in full, without any tax deducted at the source.
Okay.
It is then up to a completely different government department, Revenue and Customs, or HMRC, to claw that tax back.
Oh, man. So it's two completely different arms of the state operating in silos.
Exactly.
One department wires you the cash, and the other department sends you an invoice for receiving it.
It's wild, right? The author points out the political utility of this setup. Ministers can technically claim that they do not deduct tax from the state pension because, strictly speaking, the DWP pays it in full.
Oh, that's clever. Sneaky, but clever.
But from the perspective of a retired citizen, this is just a bureaucratic illusion. I mean, a pension does not care about the internal departmental boundaries in Whitehall.
No, why would they?
To them, the DWP and HMRC are just two hands of the same entity. One hand gives you money to survive, and the other hand immediately reaches into your pocket to take a cut.
The text calls it delayed taxation. And if we look at how the government actually extracts this money in the real world, you really start to see why the author is so furious about it.
Yeah, the human impact is rough.
It is. The source gives us this brilliant comparison. The tale of two pensioners. Let's take pensioner A, who represents a scenario the author calls the ambush.
The ambush, right.
Pensioner A relies entirely, 100%, on the state pension. They have zero private savings and no investment income.
Which means every single pound they receive from the DWP is spoken for.
Exactly. They receive their pension, and because they are on a fixed income, they budget down to the literal penny.
Right.
The money immediately goes to basic, non-negotiable survival needs, like food, heating bills, council tax, maybe a bus pass.
The essentials.
Yeah. They spend the money because they logically assume the state pension provided by the government is theirs to keep.
Makes sense.
And then, months later, completely out of the blue, a brown envelope drops through their letterbox from HMRC.
And that is the Simul Assessment Tax Demand.
Yes, a demand for £223.90. For a pensioner who has literally zero spare income, who has already spent that money on keeping their house warm during the winter, I mean, this isn't just an administrative glitch. It is a terrifying household crisis. They don't have 223 towns lying around.
It is a total ambush. The state creates a tax liability through its unfrozen thresholds, pays the money out, lets the citizen spend it on survival, and then sends a debt collector.
It's brutal.
It is. Now, contrast that ambush with the scenario facing pensioner B.
Okay, what happens to pensioner B?
So pensioner B receives the exact same state pension, but they worked a little longer and saved a little more during their career, so they have a very small private pension acting as a financial cushion.
Okay, let's say that private pension pays them a modest, 148 and 86 pence a month.
Right. So in this scenario, HMRC changes its collection method. They do not send pensioner B a terrifying surprise bill at the end of the year.
Oh, they don't?
No. Instead, they adjust pensioner B's tax code and quietly extract the tax directly from that small private pension.
Oh, wow. So pensioner B avoids the ambush, but they get squeezed instead.
Exactly.
HMRC takes 48.07 in tax out of that monthly private pension, leaving pensioner B with just 100.79. And the author highlights a very troubling trajectory here. Over time, as the state pension continues to rise and the doorway remains frozen, the tax bill grows.
It just keeps creeping up.
Right. So the amount of money pensioner B actually gets to keep from their private savings has been falling steadily. The source notes it went from roughly 117 times a month down to 106, and now it sits at roughly 100 pounds.
The private pension is essentially being hijacked. It stops functioning as a reward for a lifetime of saving and is converted into a convenient HMRC tax collection point.
That is wild. Meaning, if you are listening to this right now and you think you are safe because you have a modest workplace pension lined up, the math suggests otherwise.
Yeah, you weren't immune.
You might be protected from the sudden shock of a demand letter, but your hard-earned private savings are being quietly drained every single month just to cover the tax liability created by the government's frozen allowance. You are literally funding your own tax hike.
It is a slow, monthly erosion of the one small financial buffer they have left. And seeing the psychological and financial toll this takes on both pensioner A and pensioner B really underscores why the author insists on using highly aggressive, specific language to describe this phenomenon.
Which is where it gets really interesting regarding the language. I mean, the author absolutely refuses to play along with standard Treasury jargon.
Oh, completely.
Politicians rely on the fog. They prefer murky, boring phrases like income tax liability or fiscal drag or tax due above the personal allowance.
Because that language makes it sound like an unavoidable accounting reality rather than an active policy choice. I mean, it puts people to sleep.
So what does this all mean for the public debate? Why is the author so obsessed with stripping away that specific vocabulary?
Well, the author's core thesis is that if the primary income being taxed is the state pension, then the only honest description is to call it a pension tax.
Pension tax.
Right. That isn't hyperbole or some cheap political slogan. It is a factual description of the transaction. By forcing retirees into this convoluted system, the state is demanding that an elderly person who has likely spent 40 years in a seamless pay system where taxes were handled invisibly by an HR department.
Right. They never had to think about it.
Exactly. Suddenly, they must act like a freelance business owner.
That is such a crucial point. If you are a freelancer or self-employed, you understand the rules of the game. You know you have irregular income, and you know you have to hold back 20 or 30% of every invoice in a separate account for the tax man.
It's part of the job.
But a pensioner is not running a small business. They are living on a fixed, predictable state entitlement.
Right.
Expecting an 80-year-old to manage irregular tax liabilities and hold back fractions of their heating budget just in case HMRC comes knocking completely rewrites the social contract of retirement.
If we connect this to the bigger picture, the author is issuing a direct, almost hostile challenge to politicians.
Oh, yeah.
By stripping away the camouflage of Treasury jargon and forcing the phrase pension tax into the light, the author makes defending the policy politically toxic.
Yeah.
If politicians genuinely believe this is the right way to balance the national budget, they shouldn't hide behind phrases like frozen tax thresholds. They should be forced to stand at a podium and explicitly say, "We support taxing the state pension."
Good luck with that. I mean, no politician on earth is going to put, "We support taxing the state pension" on a campaign flyer.
Definitely not.
It's political suicide. Once the public understands the mechanics without the jargon, defending it becomes practically impossible.
Because the public does not live in Treasury spreadsheets. They live in bank balances, winter heating bills, grocery store aisles, and, the very real anxiety of official government letters dropping onto their doormat.
Which naturally leads us to how the author wants to fix this, because the text doesn't just outline the trap and complain about the injustice.
Right, there is a solution.
It offers a highly specific surgical policy proposal, and it deliberately attempts to sidestep the usual political landmines.
And what is the proposal?
It's incredibly simple. Make the basic state pension legally non-taxable and continue to tax absolutely everything else normally.
It is a targeted ring fence around one specific payment.
Right. But hang on, let me push back on this for a second.
Sure.
If we just wipe out taxes on the state pension across the board, aren't we handing a massive unnecessary tax break to millionaire retirees who really don't need the help?
That's a common objection.
I mean, someone with massive investment portfolios and multiple rental properties is going to receive a tax-free state pension under this plan. Why should the government give up that revenue?
It is absolutely the first objection any chancellor would raise, and the text systematically debunks it by explaining how the rest of the tax code functions.
Okay, break it down for me.
The author is explicit. This is not a demand to make all pension income tax-free. It is strictly about protecting that foundational state pension payout. Under this proposal, if a wealthy retiree has a large private pension, every penny of that private pension remains fully taxable.
Right.
If they have rental income, it is taxed. Investment dividends, savings interest, or if they sit on corporate boards in retirement, all of those supplementary earnings remain completely within the normal HMRC tax net.
So the millionaire retiree is still paying their fair share of tax on all the wealth they have accumulated and the extra income they generate.
Exactly.
The only thing that is protected from HMRC is that basic universal survival payment from the state.
That's it. The millionaire's tax bill might drop by 223 trees a year, which, let's be honest, is a rounding error to them.
Yeah, they won't even notice.
But for pensioner A, eliminating that 223 surprise bill is the difference between keeping the heat on in January or freezing.
Wow.
The author argues that attempting to means test the state pension to exclude the wealthy would actually cost the government more in bureaucratic administration than it would ever save in tax revenue.
Oh, that makes sense. The paperwork alone would be a nightmare.
Exactly.
Huh.
So the simplest, fairest solution is just to ring-fence the payment itself.
It completely disarms the cheap political attack that this is just some giveaway to the rich.
It really does.
And this brings us back to why this matters to you, the listener, even if retirement is decades away for you. The author makes a brilliant unifying point here. This is not a generational conflict.
No, it isn't.
It is not pensioners versus young workers. If you are a working professional grinding away in your career right now, cheering for a tax on the state pension means you are actively cheering for a tax on your own future survival income.
Exactly.
Protecting it today isn't some special favor for the elderly. It is safeguarding the baseline for yourself when you finally cross that finish line.
It shifts the entire perspective. A tax-free state pension isn't a demographic perk. It is a universal right that everyone eventually inherits.
It's powerful. To summarize the journey we've been on today, we started by looking at that frozen 12,570-pound doorway and saw how the rising state pension creates a hidden trap through the mechanics of fiscal drag.
Yeah.
We explored the deep structural friction between the DWP paying out the money and HMRC clawing it back.
Two arms of the same state.
Right. We looked at the very real terror-facing pensioner A, who gets ambushed by a simple assessment bill after spending their money on basic survival.
And pensioner B.
Yes, pensioner B. We saw how their private savings cushion is being quietly drained every month to feed the tax collection machine.
It's shrinking away.
And finally, we unpacked the author's sharp, narrow proposal. Strip away the political fog, ring-fence the state pension, make it non-taxable, and tax everything else normally.
It is an incredibly compelling argument that forces us to look past the technical jargon.
It really is.
And this raises an important question, something really vital to ponder based on the mathematical trajectory the author laid out.
Okay, what's that?
Well, we know that pensioner B's private pension is currently acting as a shock absorber. It is taking the tax hit, so pensioner B doesn't get a surprise bill in the mail.
Right.
But as we saw, that cushion is actively shrinking. It is already down to roughly 100 pounds a month.
Because the frozen doorway means the tax liability just keeps growing every single year.
Right. So what happens when this fiscal drag continues unabated? What happens in 3, 4, or 5 years when the tax bill generated by the state pension grows larger than pensioner B's entire private pension payout?
Oh, wow. The shock absorber completely bottoms out.
Exactly. When that private cushion is entirely consumed by HMRC, does pensioner B suddenly wake up one year to find they have unknowingly become pensioner A?
Oh, that's dark.
Do they suddenly start receiving those terrifying end-of-year tax demands that they have absolutely no ability to pay simply because their entire financial safety net was eaten by the state?
That is a haunting realization. I mean, you do everything right, you save a little extra to protect yourself, and the frozen doorway just keeps catching you until there is nothing left.
The trap catches everyone eventually.
That is a very powerful image to leave on. Thank you so much for joining us on this deep dive. Keep asking hard questions about your own financial future, look closely at the math, and remember to look past the jargon the next time you hear a politician talk about frozen thresholds. We'll catch you next time.